By the end of this video, you'll know the 5 specific things to check before buying any ETF. And the last one is the one most people completely overlook. If you get these right, your portfolio will be set up properly from the start. Get them wrong, and no matter how smart your picks seem, you'll be bleeding money quietly for years. So grab a drink, get comfortable, and let's go through what actually matters. All right, here's the first thing, and it's the one most people actually do check, but they still get wrong: expense ratios. This is the annual fee that comes straight out of your investment every single year, whether the fund goes up or down. Think of it like a subscription fee. The lower, the better. Here's where it gets real. Vanguard launched the world's first index fund in 1976, a move most of Wall Street dismissed as crazy. Today, Vanguard manages over $8 trillion in total assets. Their ETF expense ratios average around 0.04%. That's $4 per 10,000 invested per year. Meanwhile, the average actively managed fund charges around 0.68%. That difference seems small. Over 20 years, with reinvested dividends, it absolutely is not. There's a famous story about Warren Buffett in his 2014 annual letter. That's right, over 10 years ago. He told his family to put his estate's money into a low-cost S&P 500 index fund after he was gone. He wasn't making a small gesture. He was making the biggest possible endorsement of passive investing. Why? Because decades of data from Standard & Poor's showed that over extended periods, the typical actively managed fund failed to beat the index it was trying to beat, after fees. The fund manager was taking money out of the equation before the race even started. Now, on to the second thing: tracking error. This one's a little more subtle, but once you see it, you'll never ignore it again. Tracking error measures how closely an ETF follows its underlying index. Most people assume a fund tracking the S&P 500 holds all 500 companies in exact proportion. Most don't. Many use a method called optimization. They try to match the index's performance without buying every single stock, which keeps costs lower. That means some ETFs get closer to the benchmark than others. Let me paint the picture. In the mid-1980s, Peter Lynch ran Fidelity Magellan. He was legendary. 13 years straight of beating the market. Every investor wanted in. The fund swelled to over $14 billion. Here's what most people missed. By the late 1980s and into the 1990s, Magellan's size made it almost impossible to outperform. When you have $14 billion, you can't quietly slip in and out of small cap positions the way you could when the fund was $100 million. The fund's returns flatlined against the S&P 500. Meanwhile, the expense ratio. Remember that annual fee? Stayed close to 0.70% because actively managed funds cost more to run. The lesson isn't that active management is always bad. It's that even legendary active managers get squeezed by their own success. Tracking error in index funds is the quiet version of that same problem, and the data is hiding in plain sight, staring at you from the fund's fact sheet. All right, third thing: liquidity. This is about how easily you can buy and sell the ETF without moving the price against yourself. Every ETF trades on an exchange like a stock. But unlike stocks, ETF prices are set by something called market makers, firms that stand ready to buy and sell shares at any moment. When an ETF trades with huge daily volume, market makers compete hard. That competition keeps the bid-ask spread tight, meaning you pay almost nothing extra to execute your trade. When volume is thin, that competition evaporates. Market makers widen the spread to protect themselves, and you end up paying a real premium just to get in or out. Think about it this way. Let's say you find an ETF you like, but it trades just $300,000 a day. You want to put in $1,000. Sounds fine, right? But market makers know the volume is low. The spread might be 15 cents per share instead of 1 cent. On a $20 position, that extra 14 cents per share costs you almost 1% immediately. You've paid a tax before you even start. Over time in many trades, that invisible cost compounds in ways that are hard to track but very real. Now, if you're finding this useful so far, go ahead and hit subscribe. I drop videos like this every week. And stay tuned, because the last 2 considerations are the ones most investors never think about at all. Fourth thing: holdings analysis. Here's where we go past the surface level and actually look under the hood. 2 ETFs can track the same index and hold completely different things. That's not a bug. It's a feature of how ETF providers construct their funds. The providers use different optimization methods, and that means the top holdings can vary meaningfully between funds that share a label. Take the big S&P 500 ETFs as an example: VOO, Vanguard's version, IVV, iShares version. Both track the same index, but their actual portfolio compositions aren't identical. iShares tends to carry a slightly heavier weight in the energy sector. Vanguard runs a slightly different tilt across the top 10 holdings. For most investors, this difference never matters. But if you care about sector exposure, maybe you're avoiding energy for ethical reasons, or you want a different risk profile, those subtle tilts make the two funds genuinely different products. Most people buy an ETF based on the name and the price. The smart investors look at what's actually inside. This is where you separate a good choice from a great one. Now, the one nobody talks about: tax efficiency and dividend structure. Most ETF investors focus on expense ratios. That's the obvious cost. But how an ETF handles dividends is a hidden cost that quietly compounds against you, especially if you're holding it in a taxable brokerage account. Here's the thing: some ETFs distribute dividends regularly, quarterly, sometimes monthly. Others reinvest those dividends internally and don't distribute them to shareholders. This matters enormously in a taxable account. When an ETF distributes a dividend, you owe taxes on it that same year, whether you reinvested it or not. That's a real cash outflow you can't control. The math is brutal over long periods. Let's say you hold an S&P 500 ETF in a taxable account for 25 years. If it's structured to distribute dividends, you're paying taxes on those distributions year after year. If it's structured to reinvest internally, those dividends compound tax deferred until you eventually sell. Over a long holding period, the tax drag from frequent distributions can eat 20 to 30 basis points per year. Not a typo, per year. That's on top of the expense ratio. On a large portfolio held across decades, that difference can reach six figures easily. Different ETFs tracking the same index can have meaningfully different dividend structures because their turnover rates differ. The provider's construction methodology determines how often holdings are bought and sold. Higher turnover means more taxable events. Lower turnover means fewer. SPY, the oldest and most liquid S&P 500 ETF, distributes dividends quarterly. VOO reinvests them internally by default. Two funds, same index, different tax treatment. One of them will leave you with more money in a taxable account over time, all else equal. So there you go. 5 things that actually matter when you're picking an ETF: the expense ratio, your most controllable cost, tracking error, so you know how closely the fund follows its benchmark; liquidity, so you never pay hidden premiums to get in and out; holdings analysis, so you know what's actually inside the fund, not just what it's called; and dividend structure, the quiet tax strain that nobody talks about, but that can quietly cost you hundreds of thousands over a lifetime of investing. Pick ETFs that score well on all 5 of these, and you're doing the work that most investors never bother to do. That's not flashy, but it works every single time. If this video helped you, give it a like. It really does help me know what resonates. And subscribe if you want to keep getting videos like this, because I've got a lot more packed in the pipeline. Thanks for watching. I'll see you in the next one.